presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compact Market Wrap YouTube update for March the 2nd, 2026. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. A lot has happened over the weekend. I'm going to talk about that as the war has started in the Middle East and it has expanded. I'll talk about the impacts of that and what the market's going to do. First of all, housekeeping announcement. Make sure you subscribe to this channel. Click on the subscribe button so whenever I post an update, you'll be notified. If you need help with your portfolio, if you're anxious, if you're nervous with what's going on in the world, give us a call. We'll be more than happy to sit down with you, look at your portfolio, and sort of guide you in the right direction. Send us an email at invest@compact.com or just give me a call at 800-388-9700. Looking at the numbers, last week the market was down 0.42%. This morning after the Iran war started, we saw the market, Dow was down nearly 600 points. Now as we're going into the close on Monday, the NASDAQ is up, the S&P is flat, the Dow is down very slightly. So it shows that as far as the war is concerned, wars and these kind of events are transitory as far as the market is concerned, as long as they're not boots on the ground, and that changes the whole equation. Right now, there's no plans of having boots on the ground. Yes, this could continue for another 4 or 5 weeks. If it does, I believe the outcome will be that if we take out Iranian regime and it is replaced by a more moderate regime, that'll be a tremendous boost for the world. It will be a tremendous boost for the global economy. I mean, you're looking at Iran, which is the nexus of all the terrorism, Hezbollah, Hamas, the Houthis, and all of these other people who supplied money and equipment by the Iranians. They don't have any equipment anymore, and they don't have any money anymore, and pretty soon they won't have a country anymore. So it just depends on how long it lasts and what happens with this, and who takes over Iran after this. And the long-term global ramifications are tremendous. When you're looking at most of the oil, again, China does not have oil. It imports most of its oil. A lot of its oil comes from Iran. The rest of it was coming from Venezuela. Venezuela is out of the equation. So in the long term, it really changes the equation on the global politics and how the Chinese, which are controlling a lot of the rare earth minerals and stuff like that, but if we are controlling their energy supply, which is much more significant, then it becomes much more critical, and China might decide that it's much more better to work with the global powers and not be. So something that's long-term globally that could impact, but that depends on who takes over Iran after this is all said and done. We will take out the ballistic missiles. We will take out the nuclear facilities. Iran could end up totally demolished if they don't come around. It depends on the Iranian people, where tens of thousands of those were killed, or them were killed by this regime. Do they come out in the streets and take control over the country? We'll have to wait and see. That's why the market is taking a wait and see attitude at this point. We were down big this morning. We came back up. Last week we were down in the S&P 0.42. Dow was down 1.28. But if you look at the value, it was up. You look at emerging markets, they were up big. So that's where we're seeing the strength this year, is emerging markets and value. Utilities, the safest part of the sector, was the best sector last week. But overall energy, which spiked this morning, but is coming back down this afternoon, has been the best sector so far. Technology is one of the worst sectors of the year, down 5.5% year to date. But I wouldn't be surprised if that starts to gain some momentum as we move forward and as things calm down in the Middle East. Oil, which spiked to $130 a barrel when the Russians invaded Ukraine, was up $4 or $5 today. So not a big move in oil. And because of the tremendous surplus we have in oil already right now, and some of the OPEC countries have already said they will increase production. Bonds were down last week below the 4% area. They're back above 4% today. which is a good sign the way I would look at it. Looking at housing prices, they edged up by 1.4%. But overall, I think housing is getting a little bit weaker and softer, which is good overall for interest rates. And if mortgage rates come down, that could be a big issue. PPI was higher than expected last week, came out. I think this is a blip. Some of the data, monthly data, does get out of line. I think it'll come back up. This week we do get unemployment data, and I think that'll give us an idea what to expect. Looking at the technical, still stuck in this range that we are seeing, stuck here and right about here. So it's been a very, very tight range between 6,800 and 7,000, just going back and forth for the last few months. And if you broaden that, it's 6,700 to 7,000, going back about 4 months. So we are coiling, and that is, markets are going to snap one way or the other. When you tighten this coil, either it breaks or it springs back. I think this is, we'll have to wait and see which way it goes. The one indicator I'm watching is the NASDAQ, which is the leading indicator. We got very, very close to turning negative, and I'll talk about that in a second. Sitting at the 20-week moving average, we're below it at 68.54 this morning. We were as low as 6,800 this morning, popped right back, and we're close to 6,900. So we've come up nearly 100 points in the S&P from the low to where we are right now going into the close. Looking at the NASDAQ, again, big move to the downside this morning, but came back up and got positive on the day, which is a very good sign. My dot plot is, as I mentioned, these are the dots right here. And as the market is this right here, as the market is above the dots, that is positive. But we got very, very close to turning negative. If the market came and touched this, it would have, which number is 22,280, or really close to 23,000. This morning's low was 22,300 is this number. We got very, very close to it. We got as low as 22,306. We've come back up nearly 400 points off the lows on the NASDAQ. Also, we're at nearly 22,800. So nearly a 500-point rally in the NASDAQ from the low to where we are. But if we do turn negative like it did here, where the market came and touched this dot right here in April of last year, you can see the market was down quite a bit for about 12 weeks. So if we do turn negative and get below 22,300, I think that could be a very negative sign. On the other hand, if we can break out above 24,000, then we can accelerate to the upside, which would not surprise me. Everybody's looking at the negatives in this market. I think we got very close to turning negative this morning. We got to 6,800 on the S&P. We got to 22.3 on the NASDAQ and came all the way back up from there. We'll have to wait and see what happens over the next couple of days. Small caps also having a good day, up today after being negative. International also was down, still negative a little bit going into the close. But if we do get a pullback here and then somewhere find support, that could be a good place to add. Interest rates were down last week. We're down to nearly 4%. 3.95 is the number that we've talked about. I've talked a lot about it. We came close to it, but we've snapped back above 4% this morning. That is a good sign. Gold, it's still up today. People are buying it for safety, but I don't know how long that'll last. High yield bonds, again, one of those that were very negative this morning, came all the way back, reversing to the upside today. Those are my thoughts. Those are my observations. Again, if you need help with your portfolio, subscribe to this channel or send us an email at investorcompact.com or just call 800-388-9700. If you wanted more detailed analysis of what is going on in the markets, go to compact.com and click on Insights. That's where we have the weekly podcast, which is a longer, much more detailed version of this update. So those are my thoughts. Those are my observations for this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.